Hello, my name is Gülşah Kulalı, and this video is a summary of Chapter 2 of Business Finance 1 book. Our chapter is Financial Statements and Analysis. In this chapter, we will see the basic financial statements and their components, and how can we analyze the statements and how can we reach some conclusions based on our analysis. First thing I want to do is remind you, after you study this chapter, what can you get? We call it a learning outcome. The first learning outcome is to understand understand the information provided in major financial statements. And second, discuss the main approaches in analyzing financial statements. Third, understand vertical and horizontal analysis. Four, discuss various categories of financial ratios. And five, define issues relevant to ratio analysis. So the first thing is statement of financial position, or we can call it balance sheet too. In the balance sheet, we have different parts like assets, liabilities, and equity. And before I want to go into details of what is a current asset or what is a current liability, I want to start with this equation. This is called balance sheet equation. In all balance sheets, assets are equal to liabilities and equity. We keep it in our minds when we start to study the financial statements in detail. Asset is a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow the entity. This is the very helpful definition of an asset. We group assets into as current assets and long-term assets. Current assets are assets that are expected to be converted into cash in maximum 1 year. Long-term assets, on the other hand, are the assets that an entity expects to use for longer than 1 year time period or its operating cycle. Current assets and long-term assets together compose the total assets. If we sum up the two items, current assets and long-term assets, we will reach total assets. This is the first part of left-hand side, first part of our equation. In the second-hand side, we have liabilities and equity. For liabilities, we have also two groups, which is a current and long-term liabilities and equities. Liability is a present obligation of the enterprise arising from past events, the settlement of which is expected to result in an outflow from the enterprise of resources embodying economic benefits. This is again the definition of liabilities. If we talk about the current liabilities, it means we talked about liabilities which are settled within the next year or next operating cycle. This is short term. If we talk about long-term liabilities, then we talked about settlements which are longer than 1 year or one operating cycle. Together, if we sum up the current liabilities with long-term liabilities, we reach to total liabilities. And The second component is equity. Equity is a section of the statement of financial position, includes the amounts invested in the business by the owners or investors, the earnings or losses that are retained in the business from previous year's income or loss, and current year income or loss. These three components build the equity. In Turkish financial statements, retained earnings correspond to the sum of restricted reserves, retained earnings from previous years, and next income for the period. Additionally, there are comprehensive income items under equity. In the book, you can see all the details about this part, equity part. And one more thing to remind you from the chapter, in a balance sheet, these asset items and liability items are listed according to their liquidity. Liquidity is a term that is explaining us the time period that assets can be converted into a cash. So the most liquid asset of the company is a cash items. So the first thing in the balance sheet we can see is a cash or cash equivalents, and then we will see the other liquid items to less liquid items. Liabilities are listed as current liabilities in the first place, and short-term loans and short-term bank loans, things like that. And we will see at the bottom long-term liabilities, and then equity, because equity is a long-term statement. It includes also the capital. The second financial statement is an income statement. Income statement is a statement which shows us the profit or loss. So it starts with a sales revenue, and it continues with costs, associated costs and expenses, and associated earnings. So if we subtract costs and expenses from earnings or incomes, in the end we will reach profit or loss item. So in this slide we can see if we subtract cost of sales from a revenue, we will reach a gross profit or gross loss. And then we have general administrative expenses, marketing expenses, R&D expenses, other income from operating activities, or other expenses from operating activities. If we subtract these expenses from a gross profit, then we will reach a profit or loss from operating activities. After operating activities, we have financing activities. So we include financial income and we subtract financial expenses from profit from operating activities, and we reach to profit or loss from continuing operations before tax. After financing activities, we have to consider the tax expense. So if we subtract the tax expense from profit from continuing operations and current period tax income, if we income or tax, we can think it as net and deferred tax. we will reach profit or loss from continuing operations. And then we will see period profit loss from discontinued operations, and we reach to profit or loss. And we can calculate basic earnings per share. If we divide this profit number by number of shares, we can reach to basic earnings per share. So this is a very short version of income statement that we see. I want to remind you that income statement is showing us a result of a period of time. It's not like a balance sheet. Balance sheet shows us exactly specific days, assets and liabilities and equity. This shows that exact day. On the other hand, this income statement is showing us a whole period's flows. The results. The third thing in this chapter is vertical analysis or common size analysis of balance sheet or income statement. Vertical or common size analysis is a tool to understand how to compare the two companies, or how to not affect by price fluctuations or industry-wide fluctuations. We want to make comparisons. So we use vertical analysis. In that sense, it's useful for understanding big numbers into percentages. So we express all items in a balance sheet or in an income statement as a percentage of sales revenue or as a percentage of total assets. If we talk about balance sheet, we express each item in the balance sheet as a percentage of total assets. If we talk about income statement, then we talk about expression as a percentage of revenue. The next thing is horizontal analysis. It's called as a trend analysis too, and it is also expression of as a percentage, but in the against the time, against years. The last thing is a ratio analysis. In the ratio analysis, we define some ratios as expressions of our understanding or our aims to reach a conclusion about company's performance or company's liquidity, solvency, or working capital, or profitability, or market performance.